This episode's made possible by Planful. Hello. On today's episode of Planning Aces, we'll be featuring FP&A insights and commentary of three finance leaders, including CFO Tim Arndt of Prologis, CFO Jerome Upton of Genworth Financial, and CFO Stuart Leung of Flexport. This is Jack Swinney, your co-host. I'll be joined by performance management guru Brett Knowles, who will serve as our resident thought leader as we seek to highlight the takeaways from our distinguished group of planning aces. We'll begin after this. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Go to planful.com/CFO Thought Leader to see how you can reach peak financial performance with Planful. Hello, we're here with Brett Knowles, our favorite proud Canadian. Hello, Brett.
Hey, good to be here. It's fun that winter's coming to an end and we're seeing little birdies and green grass and stuff. This is awesome.
So, Brett, looking at the latest volley of U.S. tariffs through your Canadian lens, what is it that you see? And what should finance teams on both sides of the border be watching more closely?
Yeah, well, no, it's interesting because it directly impacts a finance team. And as you know, I'm a man with many opinions. So I'm going to tell you the Canadian perspective. But interestingly enough, I'm down here in Bethlehem, PA right now, and I'm seeing it from the other side of the coin as well, from the US side, which is interesting to me. So from Canada, my personal perspective is I'm happy for them. There's a bunch of stuff that I think Canada's been delinquent on. We've not been good at our defense, for example, and we've undercommitted, like we committed to NATO or 2% of our GDP. We've never done that. And we're allowing the United States to defend us, and we're not contributing our part. So I think good on the current administration to put pressure on the country. We've not been doing a good job of defending our border. So we have about 150,000 people that go into Canada and then immediately try to skirt across the border into the US. Thanks for calling us on that. That's our fault for not doing what we should be doing. So in those areas, I'm happy for it. You know, on the tariff side, I can understand strategically why you might want to do that. Like, how can we help bring jobs back to the States? And I can understand as a politician, that's your priority to take care of your country. So I can sympathize and understand. And again, it's pointing a weakness that we have in the Canadian economy where we haven't bothered to be self-sufficient. We've allowed ourselves to be dependent on the States for better or worse. And so I'm not overnight happy about it. I mean, there's some serious consequences. For example, we've taken all the American liquor off the shelves. I can't get bourbon anymore. Like, you know, life has come to a crisis point, but luckily I'll grab some from duty free tomorrow when I head back home. So that's my perspective. Now, other people in Canada are aggravated about it and quite mad. And, you know, they're suggesting they're not going to go down to the States and so on. And that's a solid emotional answer. But, you know, I don't think it behooves the country to not have fulfilled its obligations. So, and that might not be, Jack, the answer that you're expecting.
I can't say that it was.
Right.
I think it's worth noting that several CFOs we've spoken with this spring asked us not to ask about tariffs. And so we steered our discussions into interpreting broader economic landscape, let's say, without getting pulled into a discussion that too often, I think, swerves into politics, which little did I know I could count on Brett to help us with that.
Well, for a second, I promised to give you both sides of the coin. So I gave you my opinion on Canada, and I'm clearly not speaking for all Canadians. In fact, I might not want to go home tomorrow. They might have burning effigies at home. But we've been dealing with a bunch of U.S. clients, as we tend to do. In fact, two of them have had an audience with the Commerce Department, and one of them even with Trump, and as recent as yesterday. And it's interesting that in Canada, we're thinking it's, oh, well, poor us, life is horrible, evil USA, and all that kind of stuff. But these financial people are having the same challenges. Like, it's obviously going to drive up prices here. And it's a game of blink. Do I want to push up my price and potentially have my competition not do so, but take it at a loss? Or are we going to all agree to move our prices up 10% to compensate for it? And some of these companies in healthcare, they understand there's downstream consequences to these decisions. And so, again, both my answers from the Canada perspective is looking at Canada as a strategic enterprise, as a business. I'm looking at it from the American side, same thing, that there's issues here. And there's an emotional element to it, but there's also the logical, what do I do? I've got a 10%, 25% increase in cost, or I lose my supplier network. And, we're already seeing organizations beginning to cheat the system. So we used to have people, what do they call it? Greenwashing, where they do a bunch of ESG fake stuff to make it look like they're worried about the environment. We're now seeing people China wash it. They're taking products from China, landing them in intermediate countries, and then bringing them into the States. Like, people are beginning to figure out how to cheat the system already. So it's just an interesting new dynamic that we're playing with. The metaphor I think of is, I can remember back when I learned to drive, we actually didn't have to wear seat belts, and there was no airbags and there were no crumple zones. And when they began imposing all those stuff, there's a huge backlash. Like, why should we pay that extra amount for a car, for a crumple zone? Why should we pay for the extra cost to have seat belts? We managed to survive this long. Well, that was through the grace of God that you survived this long. And maybe airbags, seat belts, and crumple zones are a good thing. Maybe these tariffs are a good thing. Maybe they're helping us correct, if I wanted to be evil, for a bunch of mistakes previous administration has made. And it's an appropriate court. Now, again, I might never be accepted in the States again either. But there's another side to this argument that we need to get to, away from this emotional response.
Agreed. So let's take it back to the finance team. To say, one of the discussions over the last 5 years, 10 years about the customer experience and how finance is playing a really central role now in helping better understand the buying patterns of customers. No time like the present, as businesses try to understand how their customers are being impacted by the tariffs.
Absolutely. I mean, it's going to affect buying behavior, even if your particular sector isn't directly impacted. Because other sectors are. I only have so much income coming every month. If I've got to allocate more to something that's impacted by the tariff, it means I got less money for your product. And in fact, the planning aces we're going to talk to today are all great examples. And I think the overall theme needs to be, for all of us in this world, that we lack this stability in the environment that we once had. So we once used to be able to do 5-year plans. And you and I have talked about this enough recently, that a 5-year plan these days is ludicrous. I can't see out 5 years. I can see out maybe 1 year. Now I'm saying maybe you can't even see out 1 year. Like, the tariffs are changing moment to moment, but that's only one issue, right? If we think of what's happening with Russia, what's happening in the Middle East, there's like these ongoing traumas turbulence in the business environment, we need to figure out not how to mitigate tariffs, but how to better be agile and responsive to the ongoing, unpredictable changes in the environment that we can't control.
My take on the theme for this episode of Planning Aces is how finance leaders can speak candidly about the current economic environment and steer clear of the tariff talk. And I think that's what these three Planning Aces will be featuring do very well. And at the same time, they still reveal, smart bets and smart strategies. But as always, Brett, we need your help to cut through the noise.
No, that's good. I mean, that is the bottom line, because the reality is there are tariffs, but there's this whole emotional side behind it. And as a planner, if we trigger the emotional side, we're not going to get our work done. So you're right. You got to be careful of the landmine. Yep. But the underlying theme is we have uncertainty in our environment, and the volatility, the turbulence are happening quicker and quicker. And it doesn't really matter whether it happens to be a tariff or something else. We need to begin as planners, figure out how we build.
Okay, with that, I will tee up our first planning ace. Tim Arndt joined us on episode 1082. Tim is CFO of Prologis, a global logistics and real estate powerhouse. During more than 2 decades with the firm, Tim progressed from treasury and capital market roles into the CFO office. Now, Prologis owns, develops, and manages about 1.3 billion square feet of warehouse space today across 20 different countries, supporting e-commerce giants worldwide. So it has kind of an interesting intersection that undoubtedly the tariffs will impact one way or another. Here is Tim Arndt.
Again, I love real estate. I love personally businesses that are tested, that generate real cash flow, that distribute that cash flow out. If you look across my personal stock portfolio, it's going to be crowded with real dividend paying companies. Like, it's just part of my ethos and how I think about like what a great company is, and real estate is definitely in that category. So that's just for starters. But then within real estate, we've seen different sectors. Let's say the retail mall sector and its disruption from e-commerce. Let's take the office sector and its disruption from Zoom. Hotel sector, you've got Airbnb. You've got these different uses, technology, things that can throw off demand. And so when you sit and think about that for logistics, which we think about all the time, well, what's logistics disruptor going to be? What we like to say is we're more about atoms and not electrons here. Like, we're storing physical goods, and until you find some way to invent the Star Trek transporter or something and, actually beam things into our homes, they're going to need to be built, stored, and distributed. And that physical concept is going to remain. So I think the business, its thesis is really sound. Then there's 2 secular dynamics that really make it quite interesting as an investment. And one is the development and growth in e-commerce. The reason that's important in logistics, and this has been pretty well studied, but it takes 3 times more warehouse space to deliver the same dollar value of goods versus the brick and mortar channel. Okay, so $1 billion of sales in one channel versus the other is going to take more logistics space in e-commerce. And that's because, I don't know if you've ever been in a e-commerce facility, but if you just picture it, it's not storing big boxes and pallets of goods. They're actually just there temporarily, really to getting unpacked at the back of a store. That box is opened in the warehouse, and individual parcels are being pulled out, packaged, put onto trucks. So it's a much more intensive use of the warehouse space. Warehouse takes returns. The stores take returns in the other channel. So that's now dedicated space. So with every passing year's growth in e-commerce, how much of the retail sales landscape is being facilitated by e-commerce, which is growing steadily every year, really accelerated through COVID, of course, but is still growing. There's this 3 times multiplier going through our system. And it's had a secondary kind of derivative effect where that whatever you were ordering from Amazon 10 years ago, you were getting in 2 or 3 or 4 days. And now you're probably getting your things next day or even same day. So beyond that increased need, it all wants to get closer in to us as consumers. And they're not making any more land. It's hard to find land for these huge logistics facilities. So the demand is very strong, especially for infill logistics real estate. And then the supply side is challenging because nobody really wants a warehouse in their backyard. And we've seen heightened legislation around that in recent years, prohibiting where logistics facilities can be. So the supply-demand dynamics are very, very favorable. So I just think it's set up for a really great future.
It's interesting how his personal bias from what he's saying may also bias his decision at work.
So you're saying personal investing instincts can sneak into boardroom decisions more than we might realize.
And that's just an interesting observation. I don't know if he intended that or not, but in theory, what we need to do personally is very different than the investments I need to do as a business. And the criteria and the risk profile you have individually is different than the business. And so it made me wonder about why he brought that up, and does it actually bias him? And I'm not worried about him. I'm worried about your listeners and going, we need to be careful. The broader message is don't use your personal criteria when you go to the office. You got to understand your different manifestation. You and I, Jack, at the beginning talked about all the disruptors that are going on. And we talked about the evil tariffs, and I brought up the evil Putin and then Middle East and stuff. But there's other stuff going on that he points out that isn't on the front page, that is even more stressful on our businesses, right? So he's talking about, the retail malls, about offices, about hotels. I would never have thought of those things, but those are huge stressors to his business that I also have to plan around. So I think that's an interesting observation that he brought as well. Like, I loved his comment, he's in the business of atoms, not electrons. And it made me think of, Sheldon on Big Bang Theory, because electrons are a wave, they're not an actual thing, and the atoms, and I thought that was just sort of a clever idea. But so much of the SaaS world is electrons, not atoms. And so I thought that was an interesting observation. And of course, from there, he embellished with the 3 times warehouse space equation and the secondary downstream impacts that are going on. So again, the learning there is there's more to the turbulence that we're experiencing business than just what any administration's doing. There are these ongoing trends like Amazon that have these impacts, and we need to think through what are those impacts on our unique business so that we've got some sort of strategy in place.
Well, Tim's 3 times the space multiplier is really what jumped out at me from a planning angle. If warehouse demand scales that sharply with e-commerce growth, finance teams just can't plug in linear forecasts. So, Brett, it would be interesting to know what the techniques for stress testing those kinds of nonlinear assumptions before they drive what Tim's explaining, CapEx or lease commitments. All right, Brett, I know you'll find our next planning ace of interest. Jerome Upton joined us recently on episode 1090. Jerome is the CFO of Genworth Financial, a Fortune 500 insurer It spans mortgage insurance and long-term care markets. He began as an accountant who sharpened his skills during 8 years at KPMG. And then he joins GE Capital's insurance arm. And he's led finance at Genworth, and he did a minority IPO a little while back. So check out our episode again, 1090. But he entered the CFO office in 2023, and he gave us this wonderful overview of the environment that's out there and the opportunities Genworth is pursuing. Here's Jerome Upton.
I want to just touch on the economy with you. In light of some of the current uncertainties out there, what measures is Genworth taking to maintain financial stability?
Well, so first of all, I would just say all the uncertainty that's out there, I don't worry about the direct impact to my businesses, okay? And I'll explain that in just a minute. I worry about the indirect impact. If I were over leveraged, which I'm not, but we have a very comfortable level of debt, and I feel very good about the serviceability of that debt. I feel very good about the capital allocation that I've committed to the street around growth. And so I'm not worried about financial flexibility. What I do worry about is the indirect impact that the things that are going on in the market and the uncertainty around rates. So, and our Enact business, our majority owned company, to the extent that rates stay high and there's not a lot of relief and the Federal Reserve does not lower rates, the 30-year fixed rate mortgage could put pressure on the mortgage market. And so it could curtail what I call the new insurance written in that market, right? So that it's not an immediate impact, but that's an impact on the Enact business. Rates high on the life insurance side are okay because that means I'm deploying more investments at a higher yield. So I worry about the indirect impact of the uncertainty that we see. And I would have to say I worry a little bit about inflation and what could happen there because it could put pressure on our claims cost, particularly as it relates to long-term care. So inflation, care costs could go up. It could put pressure on our claim costs. Growth. I talked about our Care Scout business. We are skating towards a market that is really big, but we have to execute. And I'm going to be involved in that. I'm going to be watching that execution, trying to help that execution, because we're allocating capital. We're taking that capital, we're allocating it to growth, and our shareholders expect us to execute, and we're going to do that.
All right. Well, thank you, Jerome Upton. I should have mentioned, I, of course, kicked off that clip. You heard me asking him the question, and I thought that was important to include because of the context of what Jerome's thoughts were responding to. Brett, what did you make of what Jerome shared?
What I thought was interesting was almost the scenario planning he went through. If this were happening, it has that issue on that part of my investment portfolio or product portfolio, but an opposite one on a different part. And so obviously, if I want to mitigate the risk, I should have almost an equal portion in both of those product groups so that if it's going up, one half loses, but the other half wins, as opposed to betting on any one. So I thought that was kind of interesting that he could take a look at it in both ways and understand, as he says, like the downstream impact. But part of what we're beginning to talk about here is the uncertainty in our business environments that we now have. And in our context, we call that business turbulence. So think of turbulence you have in an airplane. You buckle up your seatbelt and you brace yourself and you're going to muscle your way through it. If you think of turbulence on the ocean, if you're in a little dinghy and you get hit by turbulence, man, you're flying all over the place. But if you're an aircraft carrier, you're not. If I'm in a large company, so the metaphor, if I'm in a large company like Microsoft or Apple, I have billions of dollars in cash reserve. I can, like an aircraft carrier, just muscle through the turbulence. In his case, it's about his capital allocation. And he's going, I've got it good enough to have a bit of, he's not an aircraft carrier, maybe he's a destroyer. I don't know my ships, but, They're not vulnerable like a small 5-person organization, but nor are they Apple. And so he's taking advantage of that allocation as a strategic lever to take advantage of the uncertainty in the market. The implication is maybe some of his competitors don't have that better capital allocation. Therefore, he can use this to make a market gain in the interim. So what I like about Jerome is he's taken, Tim's observation about, think through the impacts of and what the turbulence is to how do I begin mitigating the risk? In his case, his mitigation is all after the fact, if something changes. So what that looks like in my earlier metaphor of a car, that's a crumple zone. The crumple zone doesn't add any value till you get hit. So it's a control factor that happens after the fact. Something like better ABS brakes or driving to school allows you to avoid the accident in the first place. So it's a preventative strategy as opposed to after the fact. So what Jerome brought to the table is once I've considered what those turbulence issues are from Tim, now figure out what can I do to mitigate after the fact of those things happening.
Well, as for our next planning ace, Stuart Leung joined us on episode 1078. Stuart is a former investment banker and private equity specialist. He has championed over 15 margin improvement initiatives since stepping into the CFO office at Flexport, a global freight forwarding platform, rather well known out there. And he has since led to, he's rolled out 20 AI-driven solutions or helped roll them out at Flexport while CFO. And here's what Stuart shared with us a while back.
The key for any business is to be dynamic, adaptable, agile, right? For most companies, it may be less so for SaaS, software as a service companies that operate on, contracts, like, multi-year contracts. Things change quickly. Things can change quickly. In our business in global trade, things change all the time, right? If you think back to the past 12 months, you've had a combination of port strikes, conflict in the Middle East and the Red Sea, tariffs now, changes in customs policy and legislation, and just like general sort of trade wars, right? Things are happening or changing, week to week. So yes, absolutely. There's a ton of scenario planning that we do. We have a certain set of operating rhythms that we've put in place to make us agile, right? I talked a little bit about the Big Rocks reviews that we've done on a monthly basis. Well, we actually have weekly business reviews that run for about 2.5 hours every week on Wednesday mornings, where we review the key metrics and the data for every single one of our businesses, right? And we talk about what we're seeing, what we're learning, how things are changing, right? And that's a place where we can surface opportunity, surface risk, and also start to problem solve and discuss what are the actions and adjustments we need to take. So we get together as a management group every week, every Wednesday morning, right? And in those moments, we also talk about what we see is changing or what we hear is changing in the market as well. And what does that mean for our business? So we have built up an operating rhythm that has allowed us to be very agile, just because you have to.
Well, certainly we could do a full hour podcast on what Stuart shared. Like this was a data-rich experience. So part of what we learned from him is, mechanically, as the world gets more stressful, you end up having to have more meetings. So if your organization's under stress, like think of COVID. When COVID happened, you're meeting every single day to try to solve it. Once you begin figuring out what your new normal was, then it's, once every 2 days, once a week, once a fortnight, then it finally gets back. So it's like an accordion. When times get tough, things compress. So in his example is we got a weekly meeting. So the thought process for that is the cadence of your meetings in your organization, the simple way to think about it, model number one is, how often would you need to meet so that if something was going off the rails, you could repair it before it was irreparable? So in his example, things are volatile enough that if I missed a week and things went off the rails, I couldn't repair the damage. Now, in the old days, that used to be once a quarter and maybe once a month. He's saying it's now once a week in his business. I've noticed that different businesses have a different cadence, and even different departments do. So IT might need to meet every single day. Marketing needs to meet once every 2 weeks. So thing one from Stuart is sort out what your cadence is. Another simple test for that, just to give you a second test, is to say, if you missed a meeting, would you still know what's going on? In other words, if I missed one of those weekly meetings and I went to one 2 weeks forward, if I had no clue as to what was going on, it means I need to meet every week. If I skipped a meeting, attended the second one, and I knew exactly what's going on, then I don't need to meet every week. So use the test for your organization, your department, to figure out what the cadence is. So that's lesson number one from Stuart, which is awesome. Lesson number two, we solve with the previous people, mitigate after the risk has happened. He's talking about agile, react before the problem happens. In Canada, we've got this bad joke, I'm sure you've all heard, that, if you're out hunting with your friend, you're out, hunting bear with your friend, and the bear turns around and starts chasing you, you don't have to outrun the bear, you just have to outrun your friend. Or in this case, the joke would be your ex-friend. In the business world, I just need to be more agile than my competition. So when an event happens, and he uses the example of tariffs, if you can react faster to tariffs than your competition, you can make a gain. And so we now need to begin thinking about not what I do after the fact, but what can I do before the fact, or as soon as I know that issue is about to happen. Your airbag deploys in a nanosecond. The crumple zone happens right away. Those things are they wait till the event happens, but they're instant risk mitigation strategies. So we also now need to begin thinking about how can you detect a stress on your business faster and react to it. Now we get to go into Brett's favorite topic, which is AI. So we're dealing with a world of information overload, and there's so much data that we're talking about. It's just overwhelming for our little tiny human brains. But also things are happening in places that are not predictable. In other words, the fail-safe systems I used to have react to the problems I used to have. We never built a fail-safe system about tariffs because we never had to deal with it before. So what if I had AI now? And again, the current thing is agents. So pause for a second. An AI agent is a chunk of AI that you've trained yourself. Think of it as just another person in the room. I've begun to train that extra person on my culture, my processes, my issues, my activities, my customers, and so on. And I can go back to it tomorrow, the next day, and whatever. And it remembers a conversation we had last week and what it's learned over time. What does that mean? It means I can ask that agent, like an administrative assistant, to track 1 million data points 24 hours a day, 7 days a week. So to one side, I now need to get that agility, I need to be detecting more things in a less predictive way, like tariffs being the example, or whatever's going to happen next week. Is it measles? Is it something else? Who knows what it is? The agent, their job is to detect it 7x24 and highlight anything that it feels should be important to them. How did I do that before? I'd offshore. I'd have 20 guys in India, or I'd hire a bunch of, admin people in my company. I can now do that tomorrow morning with an agent that's effectively free. So what we learned from Stuart, and the interesting thing about Stuart is we now have new tools to solve old problems. We always had stresses, whether it was the oil crisis or exchange rates or something. We always had those problems, but we now have an extra tool in our quiver to solve that problem. And I was disappointed that our first, and even although Stuart's done a bunch of AI tools. He didn't talk about AI as part of what we all need as planners as part of our risk mitigation. Because if my competition has a planner, I'm the guy, an agent, I'm the guy that gets eaten by the bear. So the guilt part of this podcast sermon is begin looking at AI agents that can begin detecting the risks that your business might get and enable you to begin reacting to them before the competition.
Well, it's time for me, Brett, to ask you to put a bow on this for us. What are the through lines here? What are the takeaways? What are the commonalities that from these comments that we've heard today?
Well, my executive summary, just to remind people of what we just heard, is we need, the total story is we need to have more sensors out there about risks that might hit, that risks that we never had to deal with last year or the year before. So I got to move away from predicting what's going to happen to some way of detecting unpredictable stuff. And my argument is AI agents happen to be showing up at the same time. They're the perfect tool to help us do it. We then need to make sure that I've got risks in place, my metaphor of airbags and crumple zones that instantly mitigate the risk. And then I need longer term things like we heard from Tim about how I can endure less turbulence by reducing my risk based on my portfolio or how I manage my capital. So those are simple lessons, but we forget these things. And these three planners do a good job of reminding us of those things and how to solve them. I once heard a story. Apparently, when Einstein was teaching at Princeton, he was handing out the PhD physics exam, and apparently that was like 1 page, 5 questions. And one of the young ladies puts up her hand and she goes, "Excuse me, Professor Einstein, to prepare for this exam, I took out last year's exam from the library, and I see that you're asking the same 5 questions." And Einstein apparently said, "Well, you're right, dearie, but be careful. The answers are different. The answers are different for us planners now than it was a year ago. And we need to be prepared for that, even though the questions appear to be the same."
Very interesting. As we know, the whole environment could change again if Americans react to empty shelves. I think the political climate might dictate additional pullback of some of the strong-mindedness behind the tariffs.
Jack, all you're doing is embellishing my story. We can't predict what's going to happen. If you tried to map out every possible scenario, A, you'd exhaust yourself, but B, you wouldn't have the resources to deal with them all. Stop trying to predict the future and build businesses that can react to it the instant it happens. Airbags and crumple zones.
Well, what are you doing down in Bethlehem, PA?
An organization that is doing exactly what we just talked about. An organization is impacted by the tariffs. We need to reset our strategy, and we don't have 16 weeks to go through my normal end of year planning process. And so over the course of 12 hours, we've completely rebuilt the plan for this multi-billion-dollar corporation from top of the house to the bottom, 75,000 people.
Brett, as we were coming on, but before I hit the record button, you shared an anecdote about your run this morning there in Bethlehem, or maybe it was earlier in the day. Would you mind sharing that again? I thought that was interesting.
Yeah, I've never been to Bethlehem before. And being a Bruce Springsteen fan, you think of, all the old, middle America businesses and the whole story about Trump and tariffs and trying to bring business back. I'm going for a run down the river. And of course, the reason Bethlehem's here is we've got 2 rivers that converge. There's a good current, lots of mills. Awesome. I go around this corner, this path, and there's the old Bethlehem steel mill. And the thing is ginormous. It must be, I'm guessing, 12 stories high, 8 blocks long, like this big, and it's all rusted to heck. Like it looks like a science fiction movie of something that was, in Waterworld or something. And so it was quite a rude reminder of, what the current administration is trying to do. Like, we have this problem that And I can remember I had clients in Indonesia that were taking people from Bethlehem Steel 20 years ago when the layoffs are doing. Like, that big, huge thing has been idle for 20 years. And I'm sure you can't start it up again, but there used to be so many jobs and employment in this area. It was interesting just to see that relic sitting there.
It's a relic from an earlier time, but meanwhile, it's really what's helped fan the flames of our politics and led to our current economic circumstances for so many businesses. These tariffs are now impacting. Strange, ironic, whatever. Safe travels, Brett. We'll talk to you again soon.
Okay, my friend. See ya.